Hi guys, let us discuss on price to book value ratio today. Now price to book value is a very significant ratio as it gives a lot of insight in terms of how the movement of stock may probably happen in the future. So we'll understand it in a more deeper level. So as we understand, price to book value is calculated by dividing current closing price of stock by book value per stock, right? So it is used where tangible assets are the source of value generation for the firm. So this ratio is primarily used in cases where tangible assets are the source of value generation for the firm. So a lower price to book value suggests that the stock is undervalued. That is how it is generally interpreted. And it is primarily used to value financial services company, as the balance sheets are primarily composed of liquid assets, right? So as most assets and liabilities of banks are constantly valued at market values, price to book value for these companies gives a fairer picture of the value of assets. Also used for companies with no earnings, high variable earnings, or companies that do not expect to continue as a going concern. So these are some of the characteristics of the price to book value ratio. Now the market rule of thumb is that a high price to book value, say which is greater than 3, in that cases it is assumed that the stock is overvalued or it's an expensive stock. Whereas if the price to book value ratio is lesser than 1 or is on lower side, that suggests that the stock is undervalued or it's a cheap stock. So is it always true? No. We come to see many stocks with a low price to book value giving us losses in our investments, and hence we shall always analyze the stock further without just falling back on only this ratio, right? This is very significant to understand. So why some stocks trade at less than book value? Because of their fundamentals, like because of some financial troubles, a history of frauds, high debt, etc. So these are the some fundamental issues as a result of which the stock may be trading at a lower book value level, right? So there may be low growth prospects or short-term problem like cancellation of projects or recent acquisitions and stuff like that. Also recent acquisitions may increase the book value and lower the price to book value ratio, right? So the industry at large has a low price to book value, so it has to be compared with the industry at large. So that may be one of the reason that the industry is characterized in that manner. So to give you an example, like industries that require higher infrastructure capital, such as shipping industries, industries that have most of the assets which are financial in nature, such as banking and financial industries, usually trade at low price to book value ratio. Also industries with low growth prospects tend to trade at a lower price to book value ratio, for example the textile industry. Whereas industries having more intangible assets and those considered to be in the growth industries, example IT and biotech, will generally trade at higher price to book value. For example, the book value of Infosys will not factor in the intangible value of its intellectual assets. Such companies can have high price to book value ratios and still be good investments, right? So the characteristic of the industry also gets to be very significant. So you need to look at price to book value along with ROE, return on equity. So a low price book value stock with a high ROE can prove to be a good investment. So guys, this is a short video on price to book value ratios. I hope you have learned something in the process. So see you in the next video. Thanks a lot.